Alan, we're talking about the Canadian oil sands today. This is the process in Canada where they extract oil from the sandstone in Canada. It strikes me that this must be a very difficult process, a very messy process, and really a very expensive process. So I would imagine the oil sands is one of the types of oil producer that's suffering in the current low oil price environment. Is that the case?
If you look at a cost curve for oil production throughout the world, you would generally find at the top of this cost curve, the most expensive ones, would be included in there would be the Canadian oil sands projects. They're long-lived projects. They're very, very expensive to build. Easily cost $3 billion before you talk about add-ons like upgraders that turn this tar into a light sweet crude. And the production picks up during these things slowly. So it does take a while to pay off.
But are they all turning off the taps with low oil prices?
Absolutely not. They have running costs that are actually relatively low, probably in the $30 to $35 area, and those costs are probably falling as oil service costs, say labor and truck drivers and trucks and equipment go down.
So expensive to start up, but actually once they're going, they're reasonably cheap to run.
If you have some of the longer term projects, the project that's been around the longest, the Syn crude started, for instance, in 1978 and was actually expanded in 96 when oil prices were a lot lower. They have probably sunk their costs. Those kind of projects are very big and they have momentum. They will continue to grow production. Newer projects, yes, they may pull back a little bit on capex, but I still think there's plenty of growth coming.
So where does this leave oil production? I thought that one of the consequences of lower prices was meant to be that a lot of the more marginal players would just come out of the market.
The fact is that the momentum will still be there. It will come back a little bit. It won't hit the heights it might have in the higher oil price scenario. So capital spending has been cut back by almost a third since last year, at least the outlooks. Production forecasts out to 2020, that's not far, 5 years, will be less, but they'll still almost double from here to about 3.7 billion barrels per day. Million barrels per day. And already Canada is 4 to 5% of global oil production. So, if you're thinking that oil production is going to be cut off in a high cost place like Canada, think again, there's more oil coming there.
Lots of production to come, which leaves the oil price looking very interesting. Alan, thanks very much.